A very good evening, everybody. Welcome to the live webinar on Beyond Nasdaq and S&P 500. Europe's top indices are beating global markets. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be Mr. David Ng, proprietary trader from Iceberg X. Before I pass the time to David, I would like to remind everyone that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A towards the end. And now, without further ado, let me welcome David.
Yeah, hi. Sure. Just allow me to share my screen. So Minghui, can I just get a slide check? Are you able to see my slides?
Yes, we see your slides perfectly.
Yeah. Okay. Thank you. Yep. Thank you everyone for tuning in. For tonight's session. Talking on Europe market. So probably you're aware that majority of where the interest is mainly on the U.S. markets, given that those markets are hitting all-time high. So I think it's good that we can see there's also other pocket opportunities in other regions as well, and especially in Europe market per se. So I think the next half an hour to 45 minutes, I'm just going to share on what are ways and tools that we can use, especially if we want to navigate some of the leading Europe indices futures, which is available on Eurex market. So hopefully I can share certain insights that able to guide you to actually kickstart your journey, especially when you want to assess the European markets. So just before I start, just like to thank Philip Noah as well as Eurex for inviting me to speak on today's topic. And just for the audience, just for information, that any material that's presented here is purely for education purpose. And any opinion that's reflected is purely based on my personal opinion. It doesn't reflect any opinion, whether it's from the exchange or whether it's from the broker itself. So dealing in futures definitely is a highly derivative instrument, so it's highly risky. So make sure you have sufficient knowledge and you're well equipped. And I believe in this aspect, Philip Noah can able to assist you further if you want to understand more about the markets and also understand more of the products that they offer. Just to also make sure that this presentation material is not being scrutinized by regulators. So yeah, just want to keep that open, and it's purely for educational and sharing purposes. Now, I think when you look at European markets in general, there's a couple of indices that majority of people would tend to focus. I think mainly is DAX and also EuroStoxx. If you look at Eurex market, these are the two major products that's available for traders to trade, and it gives wide exposure in the European markets. So DAX is primarily the German major index benchmark, and I think EuroStoxx is mainly access to majority of European markets. So these two products is giving you giving you easy access to actually capture opportunity, especially in the European markets. Now, I think over the last couple of weeks, you've probably witnessed that markets has actually been very volatile, regardless whether it's equities, whether it's commodities. Trump is being a very big, Trump is having a big impact in terms of his policies and tariffs. So going forward, I think the next 5 months towards the year end of 2025, we're probably going to witness more volatility in the markets because of the Trump factor that is that's creating a lot of uncertainty in the market space. So as a trader, there's certain ways that we like volatility, but in certain ways also we make sure that we must have ways to counter market volatility in case market go against us in a big way. So it's always good, if you are new to the market, especially in European indices. I think it's important for us to have a plan, trading plan per se, and in terms of navigating certain uncertain periods, especially during this crucial period when Trump tariffs has actually been the common news play that's hearing all over the news wire. So I think the second part of this webinar probably going to be touching on trend trading strategies, which you are able to use certain trend tools that helps you to navigate some of the market trends that's available in the market space. So I think it's important as a trend trader, when markets are trending, when markets has momentum in terms of prices, it's always good, if you're a trend trader, when market is moving in trend and in trendy fashion, I think it's always a good opportune time. Now, if markets are in the side range, then it's always very difficult for us to employ trend trading strategies. So I think the main decision is that we need to identify whether market is trending. If the market is not trending, then obviously we need to use certain other trading strategies. But if the market is trending, definitely I think trend trading tools is one of the tools that you can definitely use, especially trying to navigate in a trendy market. I think the last bit, I'm just going to touch a little bit on micro contracts. Now, I think given that margins for small contracts are easily accessible nowadays, and the volumes are traded on these micro contracts are also quite, there's a lot of liquidity in place. So I think that's giving a lot of opportunity for traders, especially those who are new to the market space, giving them easy access to tap into the European market as a way to gain opportunity in that space. Now, I think the reality on the market now is like this. Before that, a lot of traders will probably look at or assess markets through fundamentals, through technicals. But nowadays, I think really, you just have to look at what Trump is tweeting. If Trump is saying something, obviously market will move in fashion. So I think going forward, it's still going to be the case. Despite August 1st is going to be where Trump is going to implement tariff across all major countries in the world. I think that's going to have an impact down the road, and that's going to create a lot of uncertainty and definitely volatility in the market space. Now, I think this is what market is expecting with Trump being so sturdy on implementing tariff across the board, and pretty much across majority of the countries in the world. It's definitely going to have impact in terms of global growth. So we started off the year very optimistic before Trump came to the picture, and liberalization day started on 1st April. That's where we really felt the impact of tariff kicking in. So August 1st is going to be another period where pretty much the negotiation period for lowering down tariff is going to be over. And that's where you can really see the impact of tariffs kicking into majority of the countries. Now, it's not only US is impacted. I think definitely other trading partners, especially trading partners with US, is going to feel the brunt of the pain as well. Now, in this regard, I think European economy, in certain ways, are not isolated from this effect. European market is a very huge market for U.S. economy. In fact, they are, I think, the largest trading partner with the U.S. Market. So, with tariff kicking in, it's definitely going to have a major impact. So, if you are trading this market space, you have to watch out. I think news flow about a tariff is going to be something that if you are trading European indices in particular, is definitely going to be worth watching, and it's just going to create a lot of volatility in the market space. Now, if you just look at where some of the major European indices perform in relation to S&P 500, which is a major US global benchmark, you can clearly see, DAX performing very well this year. In fact, I think year to date they are almost, I think they are one of the top performer in terms of index benchmark in relation to S&P 500. Now, EuroStoxx also did very well. They have managed to recover the April fall since the liberalization day in US. So majority of major G7 economies has actually rebounded from where it lows back in early April. And I think true enough, you can clearly see the momentum is still riding on an uptrend basis. Now, as long as S&P 500 continues to trade on upward momentum, the trend for even the DAX and the EuroStoxx market will continue to rely on stronger sentiment and stronger momentum. So the market is clearly on the uptrend, and during an uptrend market, it's clearly an opportunity for us to find opportunities. If there's any retracement, it's usually an opportunity to get into a position in the market. Now, if you just look at European region as a whole, you can see that Germany is usually the top leader in terms of the contribution to the Europe region, followed by France and Italy. So in a sense that DAX is also very similar in terms of their parallel movement with the EuroStoxx market. Now, EuroStoxx is basically an index that comprises majority of the European countries, while DAX is basically a German index benchmark. So you can see that if you want to trade either the DAX or the EuroStoxx, it's actually very similar in the sense that both move quite parallel. But I think Germany has a better narrative. There's more story to tell. In fact, you look at where Germany economy is actually slowly rebounding from the effect of Trump. Now, you just look at what the news flow is regarding tariff. The EU chairperson, has just signed a deal with Trump. So I think that's also create a lot of certainty, and therefore I think that also give a bit more leeway for the market to perform. So, but if you just look at where statistics shows, European Union is definitely a large economy when it comes to trade with the US market. And you just look at where the US trade deficit with the EU market is actually been widening for quite some time. So I think this is what Trump is trying to address. So imposing a tariff on EU region, especially with this deal that's being signed, talking about 15% across all EU countries, is pretty much trying to rebalance the deficit with the European market. Whether that will be fruitful or not is still much to be seen. But I think a lot of countries, once the deal was being announced, a lot of European countries, especially Germany, was not quite happy with such a deal, because if you just look at it, the deal is pretty much a one-sided. I would say it's a one-sided play, whereby it's a lot of commitment coming from European Union as a bloc. So it's not only talking about reduction of 15% tariff, which is imposing on across all the major export markets and European markets in particular, automobile and also pharmaceutical. So these two are the major sectors when it comes to the contribution to the US market. So I think that's what Trump is trying to do, try to rebalance the trade flow. Now, on top of that, besides 15% tariff, EU also committed to probably invest close to 750 billion in terms of American energy products, and also invest about 600 billion on top of existing what they are spending on the US market. So it looks like it's pretty one-sided, but I think when there's a deal, as long as it's a lower tariff, European Union will probably be more than happy than a higher tariff. And as long as it's continued this way, there's certainty to the market. So market take it on the first blow is quite positively, but it's still much to be seen how this will translate later on into the economy, and how will that translate down to the end consumer. Now, I think Germany being the largest economy in terms of European bloc, now Germany on its own suffered a few massive headwinds in terms of their economy stats. Past couple of quarters, they have not been doing well. They're trying very hard to try to prime the economy, lifting the markets out of the negative sentiment. I think it comes to fruitful. I think the chancellor has actually announced a couple of measures to try to strengthen its economy by encouraging companies to spend, and I think that eventually will also cascade down to its economy, and hopefully that will bring higher GDP growth for the German economy. Now, if you just look at where PMI numbers are, European as a whole looks to be gaining momentum. Although in terms of growth, is nothing much to shout about. It's still between the band of 0 to 0.5. It's still a small in terms of magnitude. But I think in terms of trend, it's slowly starting to show sign of improvement. Germany as well, you can see that past couple of quarters, there actually been a slower growth, but actually they are coming off from the negative growth and slowly moving into the positive territory, and hopefully that momentum can sustain itself, given that measures has been announced to try to support the economy going forward. Now, in terms of PMI numbers, you can clearly see there's also sign of improvement, whether it's from the EU or whether it's from Germany side. You can see, generally the economy is actually progressing well. Now, as long as this momentum continues, you should see the index performance should also perform relatively well, and the uptrend momentum that we're seeing in the index itself should continue despite the resilience of the economy. Now, the only uncertainty is that we're still too early to assess how the Trump tariff is going to have an impact, whether with significant tariff in place. Keep in mind, European is a very big market to the US economy. If US starts to impose heavy tariff, eventually some of the demands will have to shift to other countries, and how that will cascade or translate into weaker growth is still too early to tell. But I think going forward is definitely worth watching whether that is going to have a big impact when it comes to whether it's economic growth or whether the PMI numbers. Now, this chart is showing you how EuroStoxx, the index performance in relation to S&P 500. So you can see there's most of the instances is that EuroStoxx tends to move quite parallel to or move in tandem with S&P 500 performance. Now, of late, there's been a bit of discrepancy. You can see that S&P 500 tends to outperform in certain scenarios, but I think towards the later part, all in all, you can see that generally both these instances are actually moving quite in tandem. So in relation, if S&P 500 is performing well, we should able to see EuroStoxx to also perform relatively well. And keep in mind, S&P 500 is definitely an all-time high level, and I think that will give a support for EuroStoxx as well. Now, just want to touch a little bit on S&P 500, given that US is definitely on the you look at how the equity markets has been performing, is definitely on the brink of a new level. So what I have here is just to look at the margin statistics. Now, Margin statistics is in relation to looking at margin depths. So this is looking at investors taking debts to purchase stocks. So when markets are euphoric, especially when we are seeing right now, when sentiments are strong and good, normally investors will definitely pile on more debts in order to invest in stocks, because the gains in stock will hopefully be more than enough to cover the interest on the debt to purchase those stocks. Now, if you look at in relation historically, when margin debt starts to reach its peak, it's very difficult to assess where the peak of the margin debt is. But usually, when margin debt tends to peak, normally that's where market tends to be a bit more skeptical. And you can see a lot of investors when margin debt starts to peak, usually what they will do is that a lot of investors will try to assess the market. If they see that market gains are hard to come by, probably will just try to close their margin account. So in that sense, they probably be selling their stocks and to cover their loans. So that's where right now you can see that the margin debt in US is actually quite peakish. Whether it will continue is likely, but in the next foreseeable weeks or months, if the margin debts continue to 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 stay where it is and it's not going any higher, despite we're seeing an increase in the S&P 500, normally that's a signal that generally the investors are getting out of market by reducing their margin debt. So that's a good indication that we are at this point in time where valuations are stretched definitely in the US market, and an opportunity to go the room to go even higher in terms of valuations is getting narrower. So eventually, I think this one of the first telltale signs you can see where markets becomes more peak is to look at the margin debt in US. If the margin debts in US is not increasing, I think that usually be the first sign that retailers are slowing down on their investments in stocks, and that's usually be a sign in the market where that's probably will be a peak in the S&P 500 as well. Now, another important scenario in the US market right now is, if you just look at the composition of S&P 500, is very concentrated. If you just look at Magnificent Seven in terms of Magnificent Seven will probably be comprises your Meta, your Amazon, your Tesla, your Microsoft, your Apple. Now, these several companies, if you look at in terms of their market cap as a percentage to the total market cap of all constituents of S&P 500, in terms of their percentage, are roughly about 35 to 38%. That's very concentrated. So, these seven companies pretty much can dictate the movement of the whole S&P 500 index. Now, if these seven companies fail to perform, then usually that's be a sign that market will definitely be more risk on. So I think that's where we really need to be careful. US market is in a way is very peakish, and also in a sense that the concentration risk is getting higher, one-on-one basis. So as long as these seven companies continue to continue to comprise heavier percentage in terms of total market cap for the whole market, is going to get very is the risk of concentration is going to get even higher. So that's where you really need to watch out. So that comes the European market. So European markets, in a sense, is more balanced. If you just look at the top 10 constituents, especially in the EuroStoxx, you can see it's quite well spread. Now, if you look at Magnificent Seven, majority of the sectors they are in is actually mainly technology. So if technology sectors or technology narrative starts to get a bit peak, I think that's where market will tend to peak. Now, if you just look at European context, it's slightly different. It's quite well spread across different subsectors. You have technology, you have energy, you have consumers, you have healthcare. Now, even despite that, technology is also capped at probably about 15 to 16% of the total market cap of the index. So in a way, it's well balanced. You don't have any concentration risk for a particular subsector. So whenever the narrative starts to change or starts to move, or whether the fund flow is moving from one sector to another sector, you don't see much of a downfall risk, especially in the European index as compared to the US indices, which is very concentrated on the technology sector. So one point to take note, I think it's important, if you are looking at US market, you'll come to a point where there's a lot of concentration risk and valuations are very stretched. But on the other hand, you look at European markets, there's still opportunity, there's still companies, there's still valuations are still not as in relation to the US markets, is still not pretty high. It's still pretty reasonable, and definitely the representation in terms of sectors are definitely well balanced as compared to the US S&P 500. Now, I think other than that, European markets can continue to do well for the fact that interest rates are starting to decline. Now, you must understand that European or ECB has started a downward rate trend early part of this year, in fact, late part of last year. So they started earlier in terms of the down rate cycle as compared for the US market. So whenever interest rate starts to decrease, normally that usually be positive for stock prices. Now, I think again ECB is also watching where US Federal Reserve is interest rate path is. We are now entering into July FOMC meeting, which is probably we get an announcement by early Thursday morning, and whether that I think market consensus is looking at a rate cut, or in fact probably still a 50-50 gain for now. So whether it's a rate cut or not, I think it's quite clear that Federal Reserve is probably watching very closely, and if the economy doesn't do well because of the tariff, I think rate cuts is definitely imminent. In that sense, I think the ECB also has no choice but to follow along what the Federal Reserve is doing. So eventually, the interest rate path, even for the European region, is still looking at the down rate cycle for the interest rate. So in that sense, the stock market or the indices market is supported in certain ways. So as lower interest rate usually be something that's more positive for the stock markets in terms of valuation as well. Now, comes to seasonality. If you look at EuroStoxx and DAX, these are monthly seasonality in terms of their prices. You look at over the past couple of years before the pandemic and even after the pandemic, you can clearly see that there's always certain periods of the year where prices tend to react positively, and there's also certain periods of the year where prices tend to react more negatively. So you can look at it. I think coming August or September usually is a period that's usually a more volatile period for both the DAX and the EuroStoxx market. You can see that magnitude itself is even, especially in October period, usually the magnitude in terms of fluctuation in prices is usually very high. So if you are thinking to try to find position to long during the weakest month of the year, it's usually very difficult. Now, again, this historical basis, whether the market will repeat its fashion on a historical basis is much to be seen. Things can change, but I think if you use it as a guide, we are going to enter into a period for both the DAX and EuroStock market where prices tends to react more, or in terms of seasonality, plays seasonality weaker during the August or September period. So that's where you need to be careful. You're trying to think of a long position in the market. Generally, when the market is seasonally weak, you tend to see the performance tend to be weaker as well. So whether the seasonal trend can continue this year remains to be seen. But I think we are now entering into a period where prices tend to be on a weaker side, and that's where you need to be careful when it comes to trying to find trends in the market, especially on the upward momentum. So that's pretty much on looking at where the market assessment is. You can see that really the context of where European market is definitely a more balanced market to approach as compared to S&P 500. Valuations are definitely more reasonable. Now, I think the third thing is that the uncertainty will always be the trump factor in terms of tariff. Now, it's still too early to assess how the tariff is going to be affecting the economy. It's still too early to tell, but I think eventually when tariff starts to kick in, we definitely will feel the brunt of the effect. So European is definitely a very big market, even for the US and or even for the European market as well. So really, I think tariff uncertainty is going to be very dominant play as we go through the end of the year as well. So I think the next bit is looking at how we're going to navigate markets through certain trend trading tools that we can use. So I think if you're looking at ways to assess the market through trend trading strategies, one way is definitely to identify market trends. So there's many ways to do it. You can look at trends visually. You can identify through moving averages. So as long as the moving averages are pointing upwards, normally the market's on the uptrend. If moving averages are pointing downwards, normally the market's on the downtrend. So again, it's important if the market is not trending at that point in time. If it's a sideways market, it's very difficult to do trend trading strategies. Now, another I think common that usually a trader will face is that during a trendy market, whether it's an uptrend or downtrend market, a lot of traders will always find or try to assess the peak of where the trend is. It's very difficult to do counter trend trading. For example, if the market is on an uptrend basis, it's always easier to find long opportunities. If the market is on a downtrend, it's always easier to find short opportunities. Now, if the market is uptrend, you try to time where the reversal of the market is by trying to try to short the market, especially during uptrend market, is never easy. Especially when market is trending in a powerful force, it can trend for quite a long time, and eventually, if you do a counter trend trade, normally you get stopped out quite aggressively as well. So importantly, if the market is trending, always trade with the trend and not against the trend. I think next bit is, if you just want to identify the trend, it's good that we need to understand how can we position certain entry strategies based on the trend itself. So there's a lot of ways to do it. One of it is looking at candles, the different type of candles, and you just incorporate moving averages, you probably get a good entry signals. So I'm just going to share on the next couple of slides how we're going to do it. Last but not least, in every trading strategies you have, it's important and imperative that you must have a way to get yourself out in case the market go against you. And the way to do that, we always use what we call average true range, or ATR for short, by looking at the market range or the period range, and just use a multiple factor of that to assess or to gauge where should we be taking our profit and where should we be taking our loss. So importantly, we must have a plan to exit in case the market go against us, which is very common nowadays, given that the nature of the market, the volatility of nature of the market, because of the Trump effect, is going to be more volatile. So, important, you must have a way to make sure you get stop out in case the market go against you. So just to give you a brief snapshot, this is where EuroStoxx is at the moment. So you can see that majority of the candles are holding well above these two couple of lines. One we have the 50 period EMA, the other lines is the 200 period EMA. So it's a common notation is that when candles are trading both these lines, is telling you the market is still on an uptrend basis. Now, if you look at a shorter period, like probably a month or 1 or 2 months snapshot, you can see that actually market is ranging at this point in time, but it's well supported above the 50 period EMA. So if you want to look at where the next support is for EuroStoxx, just look at where the 50 period EMA is. So as long as the candles are holding well above it, the market is still generally still an uptrend market since early part of last year. So really the EuroStoxx is still generally on an uptrend. Now, DAX is slightly, in terms of bullish momentum, is slightly better compared to EuroStoxx. You can see that, even though the candles are well above the 50 and 200 period EMA, you can see that, it's still trying to break the all-time high level. So DAX generally is a better market to watch in terms of momentum strength. You can see the upward momentum is still being sustained. So crucial for these two markets, the immediate support will always be the 50 period moving average EMA line. So for the DAX market, is coinciding with the 23,200 level. If it does breach below that, technically the market is potentially testing for a change in uptrend pattern to a downtrend pattern. For the EuroStoxx, the 50 period EMA is coinciding with the 5,200 level. So these are the two major key levels to look at. But generally, the trend for these two markets is still an uptrend market for now. Now, next bit is looking at how the ways to identify trend using candles. Now, what I display here is two different charts in terms of the type of candles being used, but it's the same product, same time frame. This is talking about EuroStoxx 50 on a daily time frame. So you can clearly see, if you are trying to identify trends in the market, the chart on the right will be a better candle to use as compared to the chart on the left. So the major distinction is that the chart on the left is using candlesticks, which is generally what commonly people use, Japanese candlesticks. The candles on the right is Heiken Ashi. Now, Heiken Ashi is one type of candles, Japanese candlesticks. It derives the formulas from Japanese candlesticks. And just because it's using the average bar of a Japanese candlestick, so therefore it actually tells you, whether the trend is still an uptrend or a downtrend just by the color of the bar. So you can clearly see, in certain sections here, if you compare to using candlesticks, you can see green color candles are telling you the market journey is on uptrend. But the moment you start to see red candle appearing, you probably get skeptical whether the uptrend can still continue. Now in Heiken Ashi, as long as the green candles are still appearing, is still showing you that the uptrend is still quite strong until the appearance of a red candle. Normally that tells you the uptrend is probably facing exhaustion. So in a sense that Heiken Ashi is a much better candle to use, especially when you look at trends in the market. Now, major distinction: Japan's candlesticks are mainly used for trend reversal. So if you're looking at sideways market or or range market, Japan's candlesticks is a better candle to use. Now, if you're looking at trends, whether the uptrend or downtrend market, Heiken actually is a better candle type to use because it illustrates or it actually indicates to you whether the market is still or is poised to go even higher, especially during uptrend market, just by the color of the candle bar. Now, Japan's candlesticks is slightly different. If you just look at some of the books that's available on talking on Japan's candlesticks, they mention about 100-O pattern that you probably need to study or to look across different type of charts to recognize. So 100-O patterns is very difficult. Now, Heiken Ashi, why is it commonly used, especially for trend trading, is because there's only 3 distinct patterns that you need to know, and it's much easier. It helps you to identify trends in the market much faster as compared if you just look at Japan's candlesticks. Sometimes you really need to get confirmation in order to determine whether the market is trending upwards or downwards. Now, I would say the only difference between Japan's candlesticks and Heiken Ashi is price gaps. So if you just look at the chart before, you notice that if you use Japan's candlesticks, you can see gaps in prices. Now, if you use Heiken Ashi, usually the gaps are being covered by the candle bar. So if you try to do gap analysis or if you trade using gap strategy, you can't use Heiken Ashi. You just have to convert back your Heiken Ashi candles back to Japan's candlesticks, and that's where you can see gaps in prices. But I think that's the only tiny difference. Other than that, I think Heiken Ashi, when it comes to trend identification, is much superior as compared to Japan's candlesticks. So these are the 3 distinct patterns. The first pattern always recognized is that the moment you see a red candle bar, normally it tells you the market is on a downward trend. Green candle bar generally tells you the market is on an uptrend. Now, the first distinct pattern is always if you see a red candle bar with upper and lower wick, or even green candle bar with upper and lower wick, it's just generally telling you that the momentum starts to fade. So if you are holding into a long position, the moment you start to see green candles with upper and lower wick, generally it tells you, hey, you got the upward momentum tends to slow down. Vice versa, downward momentum, the moment you start to see red candles with upper and lower wick, generally tells you this downward momentum will start to slow down as well. The candle bar, which is the main focus, is always to look at a white body bar. Especially for a green bar, we only an upper wick. For a red bar, it must be a lower wick. It can't have upper and lower. The moment you have upper and lower wick, it's just telling you that the momentum is fading. So if you're holding a position, you should be careful. So when you have this style of pattern, the second type of pattern, where you just have upper wick for a green candle bar, lower wick for a red candle bar, it's just telling you that the momentum is very strong. In fact, if you don't see any wick, that usually tells you, if you just see a body of the candle, that tells you momentum is actually very strong. So these are the candles that you should be paying a bit more attention. The third distinct pattern is what we call almost like a doji or a small body candle. And if you start to see side by side green and red candles with this type of pattern side by side, it's just telling you the market is heading to no direction. When you start to see this type of pattern appearing, especially in the Heiken Ashi bar, it's just telling you the market is heading sideways. So just to put into context, so this is on EuroStoxx. You can see that this downward momentum is actually gaining strength given by the identification of the body bars. The red candle body bars are getting very white, and the appearance of a red candle with only lower wick. There's no upper wick. The moment you start to see there's upper and lower wick on the red candle, it's just telling you that this downward momentum is losing strength. So if you're holding short position, you should be careful when you start to see upper and lower wick candles appearing on the red candle bar. Now, when you start to see almost like the candles are very small, almost like a doji, like a cross, that's usually signals to you that market is moving sideways. So during this period of time, if you're trying to do trend or trying to identify trend in market, it's very difficult. So again, you have to be careful. Now, again, this is a series we call sideways market. Reason being because even though we start to see there's certain red candle bars, the body is actually quite white, but the series of green is also appearing. It's just telling you that the market again is heading to no direction. This is what the candles that we are trying to focus on, where you can start to see green white body bars with only upper wick. Generally tells you the upward momentum is actually very strong. So that's where in Heiken Ashi bars, if you try to identify trends, you really need to see those with white body bars and we only upper and lower wicks. When once you see upper and lower wicks appearing, that usually tells you momentum is fading. So that's where you really need to be careful. And especially in sideways market, if you try to identify trends, it's not going to be easy. Now, so just by looking Heiken actually may not suffice. You also obviously you need to incorporate certain moving averages as a way to try to pinpoint better entry and exit strategy. So if you incorporate, short-term and short-term and longer-term moving averages, you can probably get a better entry signal. So what we have here is that we incorporate a shorter-term uh, EMA, exponential moving average, and we incorporate a longer term moving average. So the crossovers usually happens when the shorter term crosses below. That generally means that the market generally is going to poise to go lower, and that's what we call a bearish crossover. And in the bullish phase, usually when you start to see the shorter term moving averages starts to cross above, generally that signals to you is going to be a bullish crossover. So if you couple that with green Heiken Ashi bars appearing, that generally tells you this upward momentum is going to be starting and gaining strength. So that's a very good entry for you to take a position, especially a long position, whenever market starts to move out of range or moving from a downtrend to an uptrend. So moving averages helps you in a way in terms of crossover to give you the direction of where the market is heading. And on top of that, if you pair that with Heiken Ashi candles, you probably get quite a good signal in terms of where the momentum starts to come in. Now, this is on DAX, so you can clearly see the same principles apply. The moment you start to see green Heiken Ashi bars, the candles are above both the moving averages, and you start to get a bullish crossover on your moving averages, that generally tells you the market is on an uptrend. Vice versa, if you start to see appearance of red candles, and the shorter term EMAs are crosses below the longer term, generally that tells you the market is poised to go lower. Now, moving averages is not only giving you the direction of where the market trend is, it's also acting as a support and resistance. So, in the earlier slides I've shown to you, if you look at the longer term, the DAX and the EuroStoxx market is holding well above the 50-period EMA on a daily chart basis. So that's usually be a very strong, dynamic, critical support for the market. So moving averages not only acts as where to identify where the market trend is also helping you to gauge where the support generally lies. So you can see a couple of instances in this EuroStoxx market, for example. Candles try to breach below, I think the green one is the longer term EMA, but it failed. In this context, it's actually the 20-period EMA. There's a couple of instances where it tried to breach below, but it didn't. Only towards the end, we call it probably this could be a false break. But then the appearance of a green Heiken Ashi candle is just trying to tell you, this breach below is actually failed by the appearance of green. But eventually the market hits lower once the appearance of red Heiken Ashi bars towards the end of the session. So really, moving averages is not only acting as a crossover, it's also acting as a dynamic support and resistance to your candles as well. Now, the next bit of indicator, which is also important for trend, is what we call a DMI. Now, I'm not going to complicate too much or explain too detail on what DMI indicator is, but it basically comprises of three lines. One, we have what we call a positive divergence line, positive DI, and the other one is negative divergence or negative DI. The third one, which is called average directional index or ADX for short, is the most important line when it comes to the DMI application. So I'm just going to go briefly. So if you look at the bottom panel here, this is basically a DMI indicator. So the green one is what we call positive DI. The red one is minus or negative DI. So the moment when there's a crossover, when the positive crosses above, generally that tells you the market is poised or the positive momentum is gaining strength. If you correlate that or you put it in parallel fashion, you compare it parallelly, you can see that the signals that's given by the DMI crossovers and the moving average crossovers are very similar. So in a sense, they're actually overlapping each other when it comes to signals generation. So, it's always a choice whether you want to use a moving average crossover or you want to use a DMI crossover. Is up to individual. But again, I want to emphasize is that the DMI, crossovers sometimes may be quite misleading, given that for these instances, you can see that the minus DI actually crosses above the positive DI, but in not a big gap. So it generally tells you that this downward momentum may not be strong. So a better use will be, in terms of part of the DMI indicator is to really focus on the EDX line, which is the third line. Now ADX runs on a value between 0 to 100. Same goes like RSI and your value indicators. So really, I think the value that you really need to look at is between 20 and 25. So there's a common benchmark in the market. Any value that's above 25 is just telling you the market is trending. Whether it's uptrend, downtrend, it doesn't matter. The moment when ADX rises above 25 is telling you the market is in trend. Now anything that's below 25 or in fact below 20 is just telling you the market is sideways. So when you see ADX value below 20, market is moving in no direction. And during this time, you should not be taking any trades until when ADX starts to go above 25, when there's an indication of a trend appearing. So this is just a table. Again, this is a very rough guide. You really have to do your back test and to really fit into your market template to see how it works across the different markets. But the general rule of thumb is this: anything that's below 20 generally tells you there's no direction in the market. Above 25, that's where you need to pay a bit more attention. Generally, that tells you when ADX goes above 25, probably there's a trend appearing. So this, if you just look at how this is being applied, you look at this black line here, which is your ADX, and this blue horizontal line is actually a 35 point line. So the moment when ADX starts to go above 25, it's just telling you that usually there's appearance of a trend in place. So what we have here is that there's a long signal here, given that the Win Heiken-Ashi bars are appearing, and most of the Heiken-Ashi bars are trading above both the moving averages. Just telling you that this uptrend is actually starting to form. So ADX rising above 25 is just further confirm that this uptrend is gaining strength. And in fact, if you are trend trading, you shouldn't be, you don't want to enter into a particular trend when the ADX value is coming down, where it's just telling you this uptrend is almost exhausted. So you look at where the peak in ADX. Once ADX starts to peak, normally that usually signals to you that the upward trend is losing its strength. So there's a rise again. This is just telling you that this downtrend is gaining momentum. So importantly, ADX gauge the strength of a trend. There's no point, you understand the direction of a trend, but you're not sure how strong the trend is. So a way to do that is to use ADX value as a gauge to determine whether the trend is still pretty much in place or pretty much exhausted. So key point to look at: always look at ADX rising above 25. Usually be a very good entry signal to take. It's just telling you the market is poised to go to the direction of the trend. Now, this is just showing you application on the DAX market. So ADX again is telling you that this uptrend is actually very strong until which is peak here. You can see that ADX is peak, pretty much telling you uptrend is exhausted. Now I want to highlight here this square here is just telling you when ADX trades below 25, you can see that generally the market is heading directionless. So when market is in a range, you can't really do trend trading strategies. So again, wait for ADX to rise above 25 again to determine where the next trend of the market is heading. Now, so we have mentioned how we use Heiken-Ashi, how we use moving average, and how we use ADX to gauge the strength of the trend. The last bit, when it comes to constructing a trading plan, you always must have a way to manage your risk. So one of the ways is to use ATR, or average true range, as a way to measure your risk and your profit target. And how we do that is simple: just use the ATR value. So the bottom panel here is basically your ATR line. So the moment when you get a signal appearing, for example, the signal here is to short Y, because you start to see red Heiken-Ashi bars appearing, and these bars are actually getting very wide. And the moment when these candles are below both the moving averages, and there's a bearish crossover, and the key part on the ADX is actually rising above 25, usually it's telling you this downward momentum is gaining strength. And the ATR at that point in time is 45 points. This is on DAX market. So basically a short entry at 24,242. The ATR is 45 points. Now again, always work on a risk to reward ratio based on the ATR. So if ATR is 45 points, you work on risk to reward 1 to 2. You're looking at 45 points as your risk, 90 points as your reward. Now, risk to reward ratio is very personal. Some traders may prefer higher risk to reward. Now, always remember this. The ideal is always 1 to 2. There's always situations there where you can even go below 1 to 2. But always work on a higher reward ratio compared to risk, because you must make your trades profitable. There's no point for you to do 1 to 1. Risk to reward is the same. Then there's no point for you to take that trade. So no, you always must have a reward ratio that's higher than the risk. But always make sure you must manage your risk by using the ATR value as a way to determine your profit target and also your stop loss level. So based on this example, 45 points is technically your risk position, and your 90 points is basically your profit level. So you place your target profit at 24,152 and your stop loss at 24,287. So that's how we use ATR points as a way to measure your risk. So this just another example. This is on EuroStoxx. So you can see that the green Heikin bar starts to appear. This outlook momentum is gaining strength because ADX is rising. The ATR, this is based on a 30 minutes trading frame. The ATR value is 9 points. So just work on again, risk to reward ratio of 1 to 2. You got 18 points as a reward, 9 points as your risk. So that's how you manage your risk and reward accordingly based on your ATR. Why do we use ATR is because when markets are volatile, there's no point to fix such a tight stop loss, because eventually you get stop out quite often. And once you get stop out quite often, you risk losing a lot of equity in your account. So always make sure if you use ATR, when markets are more volatile, the means technically you have to adjust, or you have to expect that your buffer for risk is going to get higher, because markets are more volatile, ATR value is increasing, so your risk portion is going to get higher. So that's something you have to take note if you are using ATR to manage your risk. Now there's a lot of ways to manage your risk, but importantly you must have a way to manage your risk in every trades that you do. So just want to highlight to you this the importance of keeping your losses small. You may have a high win rate, but if your risk of win is very high, it's pretty tough as well. So always have a balance. So usually in our firm, we always ask our young traders to always practice tight stop loss, keep your losses measured, and don't let it go over a certain percentage of your equity, because once you reach that percentage, it's very difficult both in terms of psychological and also trying to hit back the profit target again. So it's quite a tough high wall to climb, if you have a pretty bad risk to reward ratio, or pretty bad risk management. So just to recap, I think importantly, if you are looking at trends in market, is always to identify the overall market trend. There's many ways to do it. I just highlighted earlier, just using moving averages is a way to look at the overall market trends. As long as the candles are both the moving averages and it's trending higher from left to right of the chart, generally the market is on an uptrend basis. And importantly, to take note, when the market is trending, always trade with the trend. So if the market is on an uptrend basis, no, 5 positions too long. If the market is on a downtrend basis, 5 positions too short. Now, you can obviously look at shorter time frames, and you can identify shorter term market trends by using Heikin candles. I highlighted the difference between Japanese candlesticks and Heikin. So Heikin is a very great tool to use if you are looking at trends, short-term trends in market. So color of the bars and the less configuration, or rather, the appearance of the upper and lower wicks, or the size of the body bars for Heikin is very important. Now, if you're using Japanese candlesticks, configuration is very important. But Heikin on the other hand is different. It's working on the color of the body bar and how wide it is. So the wider it is, it's just telling you the momentum of the trend is actually very strong. Now, if you want to gauge the market strength, the best tool to use is to look at ADX value, which is part of DMI. So again, I highlighted the overlapping signals you get from moving average crossovers and your DMI crossover. So a lot of people will tend to use the moving average crossover, or just use the DMI crossovers. But importantly, the DMI tool is mainly used for the ADX value. So if the ADX value is rising above 25, it's just telling you there's appearance of a trend. And it's anything that's below 25, or in fact below 20, it's just telling you market is sideways. Last bit, it's important. You must have a way to manage your risk. ATR is a very good indicator to use in terms of looking at where the range of market is and position your risk accordingly based on the range of the market. Now, the only I wouldn't say it's a setback, but I think what you need to expect is that when markets are very volatile, your ATR value is rising, so you have to be prepared to buffer a bigger loss in terms of because your ATR value is rising. So that's where you really need to be careful when you look at ATR value, as a way to manage your risk. No, in if you are new to the market, I think it's always good to always make sure you have a way to review your trades at the end of the session. So trade journaling and post trades review are always important and always key, especially when you are new to the trading journey. So I've touched pretty much on the contract itself. I think it's important is that um, nowadays with the introduction of micro contracts is making more easier, or is more accessible for a lot of retail traders to trade the market. Micro contracts are very usually requires very low margin. If you want to get the latest margin, you can obviously ask our representative from Phillip Noah. They can be more than happy to share with you the latest margins. But I think with low margins, is so your sizing, your position sizing will be something that you can look at. Small contracts definitely will be a lot more opportunities. The reason I just want to share you the just micro DAX futures in terms of their traded contracts is actually quite massive. Per day range, you're looking about easily more than 100,000 contracts traded. So there's definitely no liquidity issue. So with more people understanding the markets, with more people participating in the market, definitely there's more liquidity in the market as well. So just to give you a bit of technical outlook where the market is heading, if you just look at EuroStoxx, I think there's potentially, if S&P 500 continues to break all-time high, there's a high possibility that EuroStoxx will probably breach the all-time high level as well. Keep in mind, it's still an uptrend market for now, despite, if you look at near-term basis, it's pretty much moving in a range. But on the longer term basis, it's still an uptrend market. So in the uptrend market, always find opportunity for it to long. So any retracements will be a good opportunity to find any long opportunities. Now, DAX is definitely gaining on a better momentum, and looks like it's have more strength as compared to EuroStoxx. So really always look at the 50 period EMA as the next crucial support level, whether it's for the EuroStoxx or for the DAX market. So as right now, you see the DAX market is holding well above the 23,800 level, which is coincide with your 50 period EMA. So if there's no breach below that level, the market can still poise to go higher. Now ADX is below 25. It's just telling you the market right now is ranging. So there's no clear trend in sight. So obviously this is daily candles. If you go into if you do intraday trading, obviously you need to use smaller time frames or shorter time frames. Now ATR is also pretty. You look at ATR for DAX is in general, I think per day you're looking at about 350 to 400 points change movement. About EuroStoxx, you're looking at easy about 100 to 50 to 100 points. So it's really a different market play. So DAX is clearly more volatile as compared to the EuroStoxx market. So last bit, I'm just going to end here. Just going to end things on a lighter note. If you have not catched the F1 movie, I hope you have done now. You have watched it once by now. So I just want to share a little bit insights if you have watched the movie. So as what the movie highlighted. So having hope is great. However, it's not a strategy. So many new traders who are new to the market, they always hope for market to move to certain direction, or hoping to certain strategies might work. Now, hope is generally not a strategy. So you always must have a plan to work with the market. Without a plan, generally is literally you're just planning to fail in the market. So as a start, try to have a plan, create a comprehensive trading plan. I just share with you a template on how you can do it. If you are looking at using trend trading tools as a way to trade the market. Now, I think the second bit is also very important. Sometimes, in markets, it's never always a winning situation. It's never 100% guarantee movement. So, whatever tools, whatever strategies you use, it's always probability. So, it's a way we manage that probability. And importantly, whenever we don't make money in the market, it's always good that we use that opportunity to understand which are the areas of weaknesses that we still have, especially when we navigate in the market space. So with that, I'm just going to end here and probably open up for questions if they have any. So if you have
Thank you.
questions, just feel free to put into the question box. I'll just look at it and probably answer. So I'll just probably give you 20 seconds then before I start answering. Okay, I can see a couple of questions coming in. So I'm just going to address it. One of the audience asked, moving average is generally a lagging indicator. Is DMI also a lagging indicator? Yes, correct. So moving average generally is a lagging indicator. DMI in certain ways are also a lagging indicator. But keep in mind, why I put up DMI or why I use DMI as a strategy as a tool is mainly for the ADX value. So the ADX value presents, uh, insights on how the strength of the trend behave. So importantly, once you identify where the trend is heading, uh, DMI is very critical in terms of telling you whether the trend is still strong or not. There's no point entering to a trend when is the trend, the strength of the trend is almost at its peak, or you're almost entering the tail end of the trend. So DMI works in that sense. But keep in mind, yes, correct. Both moving average and DMI is generally a lagging indicator. Now, another question from the audience. This strategy is best for which time frame? Which pair of EMA to use for daily uh, and shorter time frames, whether it's 4 hour, 2 hour, an hour. Okay. Now, it really depends on the product. So for DAX market, generally, I think 30 minutes time frame is sufficient. Anything below 30 minutes, sometimes you get very, if you use Heiken actually, you get very mixed signals. So 30 minutes is usually a good time frame to start off with. Which pair of EMAs to use? So 30 minutes, you use an EMA 9 for shorter term, EMA 20 for the longer term. So that's generally how we use the EMA's crossovers periods together along with the time frames that's used for DAX. Now, EuroStoxx slightly different. I think EuroStoxx generally is less volatile, so you don't see much. If you go to 30 minutes, you don't see much of a activity. Sometimes you need to push it to an hour or probably 2 hours, where you can start to see there's a bit more trend in place. So EuroStoxx, because of the less volatility, the nature of lesser volatility, so a higher time frame is preferred whenever we look at EuroStoxx. Again, the same period 9 period and the 20 period EMA still apply uh, for the EuroStoxx as well. Okay, what is your DMI settings? So DMI settings, I set it to default, which I think is 14 period if I'm not mistaken. So I just set it to default. There's no specific setting which I set on the DMI settings. Okay, what are two EMA parameters to determine trend in your chart? Okay, I just answered that earlier. So basically, is the 9 period EMA and the 20 period EMA. Now, if you look at longer term per se, which I showed to you, know whether the longer term trend, the market is heading uptrend or downtrend, I use a 50 period and a 200 period EMA. So usually that what's the market is also looking at on the longer term frame. Usually they use a longer period EMAs, but a shorter period, usually I use a 9 and a 20 period EMA. Okay, can you explain how would you interpret Heiken Ashi candlesticks? So allow me to just share back my screen. Perhaps maybe I'm just um, going back to the Heiken Ashi candles. So keep in mind, Heiken Ashi candles are three distinct patterns. So the major patterns are always by the color of the candles. Green color candles is telling you the market's on an uptrend. Red color candles are usually on a downtrend. So the three distinct patterns are this. Once you see you know green candles, white body, red candles, white body is a strong trend. Whether it's uptrend, downtrend doesn't matter. So trend is identified by the color of the candle. Now, if you start to see upper and lower wicks appearing on a candle body, that generally be a signal to you that if you're holding to a position, you have to be careful because that trend is starting to lose its momentum. When you start to see small body like a doji or like a cross, generally that tells you that the market is heading to no direction or it's a sideways market. So sideways market, you can't use trend trading strategy. So just to put the context, I just to reiterate here again. So you start to see these red candle bars, white body. It's just telling you this market is poised on a downtrend. Okay, and the downtrend momentum is actually quite strong because of the how wide the body bar is. When you start to see body bar starts to get narrow, or you start to see like a cross candles appearing, or even a green candle appearing on a series of red candle, usually it's a telltale sign that this downward momentum is losing strength. So that's why again you're holding short position, you have to be careful. Another pattern you need to understand in Heiken Ashi is that when you see a small, almost no body but like a cross like that, like a dodgy style of candles, this period or this area here is just telling you the market is heading sideways. There's no trend in place. So you just have to wait when trend starts to form again. Now, the part I circle here, these are what we call strong trend candles. Why is it strong? Look at the body of the candles. It's very wide. So once the body of the candles are wide, and green candles is just telling you this upward momentum is gaining strength. This trend is very strong. Same goes for here. Now, red body candles, again, when you start to see it's getting wider, it's just telling you this downward is very strong. So Heiken Ashi candles is interpreted in such a way. So it helps you to identify where the trend is existing, and whether the trend can still persist just by looking at the candles of the bar. So the body of the candle is important. The color is the color of the candle bar is also important. So that's how we use Heiken Ashi to interpret when it comes to trading style. Okay, I'm just going to take probably one or two more questions in view of time. Then I'm going to hand it over to Min Hui. Okay, is it correct to say that DMI and ADX must be above 25 to take a trade, or it is either one? Now, I would say this. Don't be confused. So ADX is part of DMI. So DMI, there's three particular lines. One, we have the positive DI, one we have the negative DI, and the third one, which is the critical one, is the ADX line. So ADX goes on a value 0 to 100. So when you may want to identify trend for ADX, you must have ADX value above 25. So once you start to see ADX line crosses above 25, from 19 or 25, it's just telling you that, hey, market is going to have, or the market trend is going to have more strength, or the market is going to start into a trend phase. So critically, I think, importantly, do not be confused. ADX is part of the DMI toolkit, and ADX is mainly used to gauge the strength of the trend. Now, the other two lines, the positive DI and the minus DI, just telling you the crossover strategy is just pointing to you where is the likelihood the market is heading lower or higher. Okay. Yeah, I think I'm just going to stop here. So over to you, Minhui.
All right, thank you very much, David, for the sharing and also the very engaging Q&A. To our audience who may have more questions, you can still send them to us via the survey that will be appearing when the session ends. And with that, we have come to the end of the webinar. Thank you again, David, for the insightful session, and thank you, everybody, for your time tuning into this webinar tonight. We'll also be sending everyone a link to today's webinar recording so you can watch it again if you would like to. And that's all for today. Thank you, everyone, and have a good night.
Thank you. Thank you.